So first thing is be sure to read the general instructions at the top, right? In this class, we are steering you away from being experts at doing multiple choice to actually making numbers and answering questions that you're going to encounter in the real world, right? So your numbers count, the instructions count, the number of decimal places, the units, all that has to be correct to be the correct answer. So read the general instructions at the top. Those have been there for all the homeworks, so nothing new with those, but be sure to read them because they change from assignment to assignment. So there's really nothing right now, and again, this draft may change a little, there's really nothing right now from chapter 1, but it starts with chapter 2, and we looked at capital market transactions. Chapter 2 was about capital markets and securities. So we started with what are capital markets? What are capital market transactions? So capital market transaction is where you go out to get a bunch of money to build a new factory, buying a company, some big deal thing like that. It's not for if you're Mattel and you need to make a lot of Barbie and Ken dolls and you need to borrow some money to get the plastic to use in the molds to make your inventory. It's not that. That's day-to-day stuff. So you need to know the distinction between capital markets and money markets and capital transactions and day-to-day financial transactions. So expect I would say at least 2 questions on those topics. Then also we talked about marketable securities and what they meant. So what we had was bonds, loans, and shares of stock, right? Bonds and loans were contracts, and shares of stock are just certificates of ownership, right? And then additionally, we looked at shorting stocks and call options, which are a type of derivative on stocks, okay? So if you like a company and you think it's going to appreciate in value, you'd want to buy its stock. If you're an equity investor, right? If you're a debt investor, you'd want to make a loan to the company. But if you're a stock investor, you'd want to buy some shares of stock or what? Or buy a call option, right? That is going to help you if the price goes up. If you look at a company and you think it's set to have a great crash in price, you're going to either do nothing or you're going to sell short some shares of stock, right? Selling short is, again, where the price is up here, you borrow someone else's shares, you sell them out into the marketplace at this high price, you wait for the market price to drop down, and then you go out into the marketplace, you buy a bunch of shares back, return them to whoever you borrowed them from, and you enjoy the profit, which is the difference in your sale price up here and your buy price down here. So with shorting stock, your first move is to sell the stock. All right, so you need to know those marketable securities, stocks, bonds, and loans. And then we need to know the call option and we need to know shorting. So on that note, definitely count on a question or two, a numerical question or two on using call options when you feel like a stock's going to appreciate in value. I strongly recommend the way to do that is with the table that has the first column is event, the second column is time, and the third column is cash flow. That's the way I did it in class. That's the way the solutions look if you look up the solutions, and it's very hard to get a wrong answer if you do that. Same thing with shorting. I recommend use the same table, event, time, and cash flow to or from you. Cash flow out from you is negative, cash flow in to you is positive. The one other thing I'd say on that that's really important to remember is a call option will give you the right, but not the obligation to buy a security in the future at a certain price. So if things go against you for a call option, that would mean the price of the stock going way down. You can just choose not to exercise your option. So you can choose to do nothing in the future, and that will help you out. So be sure you understand those. I'm going to hold on questions right now. Keep it just so for the recording it stays kind of smooth, but I'll be happy to take questions at the end. Okay. And let's see what else about that. I think that's pretty much it for chapter 2. I would not worry so much about futures. We looked at the future as example with the oil heating. I wouldn't spend too much time on that. So then chapter 3 is really just for you to say to yourself, okay, what parts of financial accounting do I not remember that we're using in this class that I need to know? And you need to learn those, right? So that's really for you. The only specific thing in chapter 3 I'll count on you knowing is that net PPE, which is gross PPE minus the amount of wear the PPE has incurred to date, or gross PPE for the accountants among us minus accumulated depreciation. Then into chapter 4. In chapter 4, we were doing balance sheet valuation method. So count on a balance sheet valuation method mini case, right? So it'll be like 4 questions, very similar to what we did in class, right? There'll be a balance sheet. You'll have a managing director who says, I think the inventory is only worth half this, this, and that. And then she says, using the balance sheet valuation method, what's our estimate of intrinsic value? What's our best guess for the actual worth of this firm? And then also she'll say, what is the market value? What's Mr. Market's view? And Mr. Market's view is always number of shares outstanding times price per share, right? And then she'll say, based on those 2 things, should we buy some stock or buy this whole company? That's exactly what we were doing with the Drilling Unlimited problem, with the homework problems, the concept quiz problems. And I'll set that up for you so that there won't be propagation error. So if you get your intrinsic value wrong, you won't get all the other 3 questions wrong too. Okay, but that's what I mean by a mini case. It's just exactly the type of thing like Drilling Unlimited or a homework problem that we had in class, with probably 4 questions or so total. So that's chapter 4. Chapter 5 was extra credit. It's truly extra credit. However, it's a balance sheet valuation method example. So if that could help you study, if that's another thing where you could say, I want to look at another balance sheet valuation problem, chapter 5 problem would probably be good to look at. But if you don't look at it, it's not going to hurt you in any way. So then really we're moving into chapter 6. And chapter 6 is where we want you, as Miami Business School grads, whether you're going to be starting your own cool company or you're going to go on to be CEO of a company in 10 to 15 years from now. It doesn't matter if you're coming to it from marketing or from data analysis or accounting or finance. We want you all to have an ability to talk to your CFOs, talk to other CEOs and CFOs, talk to venture capitalists in a way that shows that you understand the basics. So the basics for us are the 5 frameworks for understanding the financial health of an entity: sales and sales growth, margins, efficiency ratios, leverage, 2 types of leverage, and liquidity. And for each of those, we need you to know how to compute some basic ratios, which you've done a lot of examples of, and answer some very straightforward questions indicating that you know the meaning of those ratios. And if a venture capitalist came to you and said, in the next year or so, what's your liquidity situation looking like? You'd know, oh, I better go look at my current ratio, and tell them, well, looking at my balance sheet and my current ratio, it looks like it's at about 1.5. So we have 1.5 times cash and stuff we think we can convert to cash, then obligations we know we have to pay in the next year. Basic stuff like that. That's the key thing we're getting at in chapter 6. Also in chapter 6, though, very importantly, we took a deep dive into the 2 types of leverage: financial leverage and operating leverage. So you need to know both of those. The key thing is, for both of those, more leverage means higher ROE in good times, more risk of bankruptcy in bad times. You get there in very different ways for financial leverage than operating leverage, but they both work fundamentally in that same way. Financial leverage ratios are always debt over something, like debt plus equity or assets. The bigger the ratio, the more financial leverage. Really, the more debt relative to other stuff, the more financial leverage. The better the ROE in good times, the more risk of bankruptcy in bad times. For operating leverage, that's really our measure of fixed costs to variable costs. Fixed costs are always in the numerator, so more fixed cost means more operating leverage. We only had 1 ratio to measure that in our LOVE and UAL ratio analysis. That was the SDI to COGS ratio. But importantly, and you should understand these, we looked at examples where we compared income statements and balance sheets for a highly levered, highly financially levered company. That was the Cowboys versus the Conservatives. And also, when we were sitting around owning Home Flippers Inc., thinking about whether we should do this project just using our own equity or also with some leverage, with a big loan. So you should understand we had problems like that in class and in the homework, so you should understand those. Similarly, with operating leverage, we looked at West End compared to the Carpenter, and in a good year, a very good year, West End did much better. In a very bad year, the Carpenter did much better because she had much more variable expense, much less fixed expense than West End. And we did some examples in the homework comparing balance sheets and income statements for companies like that. So you need to understand those aspects of financial leverage and operating leverage. So expect some concept questions on those, as well as numerical questions on those. That's really about it. So give me a second to turn off this recording, and then I'll be glad to take some questions.